Hello and welcome to the second walkthrough video for chapter 14. In this video, we are specifically going to look at problems related to the effective interest method. At this point, you are professionals in terms of recording the issuance of bonds at a premium, at a discount, and at par. And I just want to throw a tiny wrinkle in there by showing you the effective interest method, because most companies do use the effective interest method. It's just a little more accurate than the straight line method. And also want to do a problem with you on the extinguishment of debt, especially when debt is retired early, so that you can see the process for recording those entries. So we are specifically going to look at brief exercise 14.6 and brief exercise 14.9. So if you have your book, again, we're starting on page 14-36. So for brief exercise 14.6, on January 1, 2020, JWS Corporation issued $600,000 of 7% bonds due in 10 years. The bonds were issued for $559,224 and pay interest each July 1 and January 1. JWS uses the effective interest method. Prepare the company's journal entries for the January 1 issuance, the January 1 interest payment, and the December 31st adjusting entry, assuming an effective rate of interest of 8%. So that market rate of interest is 8%. Now, if we were in a classroom together, I would stop and my first question to you would be, are these bonds issued at a premium or a discount? And you would be able to answer that question by looking at the cash proceeds versus the par value. So we have $559,000 and some change in cash proceeds and a par value of $600,000. So when we get less cash than the par value, bonds are issued at a discount. Another clue that these bonds are issued at a discount is that the market rate of interest is higher than the contract rate of interest. The bondholders end up earning a higher rate of interest because the more risk you take on, the higher the interest. Now, we're using the effective interest method, which will not impact how we do our, it will not impact how we do our first entry in terms of the issuance of the bonds, but it will impact our entries in terms of how we deal with the interest payments. So let me resize my columns. At this point, you guys know I'm horrible at doing more than one thing at a time, I should say. I get distracted really easily. All right, so I just want to resize. I need to resize my columns and format my columns for numbers. Okay. Now, I don't have to calculate any cash proceeds for this one. I was given the cash proceeds. So let's do the entry on 1-1. On 1-1, I know I'm getting cash. I need to make that bigger, and not necessarily for you, but for me. Okay, that's better. So I know I'm going to debit cash for the 559,224. And bonds payable, always valued at par. So I'm going to credit bonds payable for the par value of $600,000. Now, of course, my entry doesn't balance, and it doesn't balance because there is a discount on bonds payable. So I'm going to show the calculation for the discount on bonds payable down here, but it's just the difference between the cash proceeds and bonds payable, or the par value of the bonds. So let's take 600 minus 509, 224. And when we do that math, we end up getting the 4776. Now, in order to make my entry balance, I need more on the debit side, which does make sense because we said these bonds were issued at a discount, and when bonds are issued at a discount, we need to use the contra liability account, discount on bonds payable. That account does have a normal debit balance. Yeah, let me make sure I did my pre-calculation numbers correctly. All right, 600,000. Okay. So that takes care of the first entry for the issuance of the bonds. Now let's deal with the first interest payment date. On the first interest payment date, skip a couple of lines. Using the straight line, not the straight line method, but if we were to be using the straight line method, then I would just take this 4776 in the discount and I would divide it by the number of periods. And I think in this one, these were 10-year bonds and interest is paid 2 times a year, so it would have been for 20 periods. But we're not using the straight line method. We're using the effective interest method. With the effective interest method, we find interest expense first. And then we take the difference between interest expense and our cash interest payment to determine the amount of discount we need to amortize. So we're kind of flipping things around here. We find interest expense first. So let's find that interest expense. And we do that by taking the carrying value of the bonds. On the day the bonds are issued or at this first interest payment date, that carrying value is the same as the cash proceeds. So we take that carrying value and we multiply it times the market rate of interest. Now the contract rate was 7%, but the market rate or the effective interest rate is 8%. So multiply that times 8%. And then we still need to multiply that times a half because the 8% is an annual rate and interest is being paid out 2 times a year. So once we do all of that, 28 times 25, 22, 3, okay, good. That matches what I calculated before. 22,369. And there's actually some change here. And I think this is one of those rare times where I want to show the change. You don't have to. You can round up to the nearest dollar. Oh, going the wrong way. There we go. So this is the amount of interest expense that we would need to record. So let me go ahead and put that in. Interest expense. Pull that number right from there. Now let's find the cash that is actually going to be paid out. Now the cash that will be paid out will remain the same every single period. It's based on the contract rate of interest and the par value of the bond. So this is where we take that 600,000 times the contract rate of interest of 7% that was given to us, and again times half and we get 21,000. Now, let me put that back up there so that you can see what I did in that formula. I just multiplied out what is written here. Now, cash should be credited. So I know that I am paying out cash of 21,000. Remember that when bonds are issued at a discount, the interest expense is more than the cash that we are paying out. So that means we need to end up crediting discount on bonds payable because the amortization will be added to the cash to equal up to the interest expense. So we find our amortization by taking the difference between the interest expense of 36, put my comma in here, 22,368.96 minus the cash that will be paid out. Put that there so that you can see how I'm calculating this out. And of course, I want my decimals. So now I want to drag that 1368.96 up here to the credit side. And again, I want to show my pennies. So we're going to credit discount on bonds payable. Again, which makes sense because I'm slowly trying to eat away at the account discount on bonds payable. And it started off with a debit balance, so I'm going to credit it to reduce that amount. Now, if this were the straight line method, I could take these same numbers and use them again on December 31st and I have to do my adjusting entry. But for the effective interest method, interest expense changes every single period because we calculate interest by taking the carrying value times the market rate of interest times a half. Well, the carrying value has changed. It's no longer 559224 because I've recorded some amortization. In other words, my carrying value that started off at 559224 is one step closer to this 600,000. So when we do the entry on December 31st, we have to first find our new carrying value and then multiply that by the market rate of interest to find our interest expense. Now, let's do that. So on 1231, I want to skip some lines here. Let's first find our new carrying value. Now, I'm going to add the amortization of the discount on bonds payable because remember, we're slowly moving up towards the par value. We originally got less cash than the par value of the bond. So the amortization of that discount on bonds payable increases the carrying value of the bond. So we're getting closer to our par value. So we're going to add that 1368.96. And then all of that will be multiplied by 8% by half. So don't forget that step. Sometimes students move on to the next period, or you may have to do it for a third period on an exam, or you may be asked to calculate or to find total interest expense for the year, which means you'll have to calculate interest expense for period 1, then period 2. And what some students will forget to do is they'll forget to determine the new carrying value when calculating interest for the second period or the third period. So don't forget to find that new carrying value. Now, let me do my work here and put in my number. And ignore me for a second as I type in my formula. Yes, I could have set this up with beautiful formulas all over the place, but I don't want to turn this into an Excel class. 8 times a half, and I got 2. I don't like this number. Let's see, I did something wrong. 559, 224. Okay, and of course I don't like this number because I want to show my pennies. 4. And you can leave it as a whole number. That's perfectly fine. If you leave it as a whole number and you do your calculations, the numbers may vary just a tiny bit. But if we're talking about a test problem where you're working out a manual problem, I ask that you show your work, and then I can see it's just a rounding error. If it's a multiple choice question, then of course always choose the best answer. But this number is our interest expense. The interest payable, which is equated to the cash, is still the same number, still the 600,000 times the 7% times a half. That's my cash, or in this case, interest payable. Interest payable. And then we have to find the amortization of that discount by taking the difference between the interest expense and the cash payment. This minus this. Because I'm being nitpicky, I'm making more work for myself. Discount on funds payable, and I really should say the amortization. So now let's throw all this up here in my entry. I know that interest expense is the first number that I calculated. It's at 22,423. So notice how it varies from period to period. It keeps changing. I know I will be crediting interest payable. I keep wanting to say cash, but it's interest payable because I'm doing this adjusting entry. The cash will be paid on January 1, the very next day. And then because interest expense is higher than the cash interest payment that will be made on the very next day, that means that I am crediting discount on bonds payable for the amount of the amortization. So notice that that amortization amount and the interest expense using the effective interest method changes every single period. And again, for consistency's sake, if I nitpick in one area, I got to continue to nitpick. But it's probably easier if you just round it up to the whole dollar. All right, that takes care of how to amortize a bond using the effective interest method. Now, because this problem dealt with a bond discount, to calculate the new carrying value, we add here. But if this was a premium, we would subtract. You see where my cursor is? We would subtract the amortization of the bond premium from that previous carrying value to find the new carrying value. So that's the big change, other than how we would do the entry. We would end up debiting premium on bonds payable, and the interest expense would be lower than the cash interest payment. So just keep that in mind as you are working through your homework problems. Now, this was brief exercise 14.6. Let's do another one. Not specifically on this, but let's do another one on the redemption of bonds or the extinguishment of debt. And I believe at the beginning of this video, I said it was brief exercise 14.9. So let's do that one. Before I read all that, let me copy and paste here so I can have my similar formatting. I'll delete all that. And I'll make that bigger. All right, brief exercise 14.9 with the redemption or the extinguishment of debt. On January 1, 2020, Henderson Corporation redeemed $500,000 of bonds at 99. So that the 99 is the redemption price there. And at the time of redemption, the unamortized premium was $15,000. Prepare the corporation's journal entry to record the reacquisition of the bonds. So reacquisition, tons of fancy words here. The only thing that's really happening is that the corporation is buying the bonds back early. And they're buying the bonds back at a certain price. They can pay 100% of par value, they can pay 102% of par value, or like in this problem, they can pay 99% of par value. But keep in mind that this time the corporation is buying back the bonds, or they're paying off the debt. So we're going to see cash going out instead of cash coming in. So it's just the reverse here. So the first thing we need to do is find the amount of cash that we're going to have to pay out. And that is determined by taking the par value of the bonds and multiplying it times the redemption price of 99. Move that cursor so you can actually see. And $4.95. Now that's the amount of cash that we're going to be paying out. And I should have put this here so that I'm not driving so far. Now we're going to compare this cash to the carrying value of the bonds to determine whether or not there is a gain or loss. So if we're dealing with bonds and there is a premium or a discount, then there could be some type of gain or loss on the redemption of the bonds. And again, we're calculating that by comparing the carrying value to the cash that we're paying out. Now the carrying value of the bonds is this $500,000, that par value. And in this case, because we are dealing with a premium, it's minus the premium. If it were a discount, we would be adding. So in terms of calculating that carrying value, not interest expense like we were doing before, but in terms of it being amortized, where we're reducing that discount on bonds payable. Here, we're just trying to find the carrying value. So we're looking at it from a balance sheet perspective. We have a balance of $500,000 in bonds payable. We have a balance of $15,000 in discount on bonds payable. When we combine those two numbers together, it's going to give us our carrying value of $485. Now, I wanted you to do it this way so that you can really do your common sense check. And your common sense check says this. If I'm saying these bonds are worth $485,000, but I am paying the bond holders $495,000, I'm giving them more money than what I'm saying it's worth. In other words, I'm paying a little bit more to get rid of this debt, and that represents a loss. So the difference between the cash that I'm paying out and the carrying value, in this case, because the cash is more, I'm paying out more than what it's worth, it's a loss. If I got to pay out less than what it was worth, then I made off pretty good. It would be a gain. But in this one, it is a loss. Now, that's one way to sort of use a common sense check, and that common sense check is going to come back into play when we populate our journal entry. So sometimes doing it that way may not make sense. By the time we get to the journal entry, it will start to fall into place. Now, for the journal entry, let's deal with what we know. I know I am retiring debt, so bonds payable is coming off the books. Let me debit bonds payable. Bonds payable is always valued at par, so no, I'm going to debit that for $500,000. It's gone. Now, discount on bonds payable is also coming off the books. So let me skip a line here just in case there's something else that I need to debit. So discount on bonds payable has a normal debit balance. To get it off the books, I need to credit it. So we're going to credit discount on bonds payable for the 15,000. I'm sorry, I think I said there was a loss of 15,000. There's a loss of 10, not 15. Don't know how to subtract. The discount on bonds payable is 15,000. And what else do I know about this entry? Let's see. I know that I'm paying out cash in the amount of $495,000. That's because I wanted to be nitpicky earlier. So now I'm paying out cash in the amount of $495,000. So from just looking at this so far, it feels like I've recorded everything that I need to record. I'm taking debt off the books, and I'm using cash to get rid of it. If the cash that I was paying out was equal to the carrying value of the bonds, then the journal entry would be done. But I know the journal entry is not done because it doesn't balance. Take a look. On the credit side here, I have a total of $510,000. On the debit side, I have a total of $10,000. What does that debit amount represent? It represents the loss on redemption of bonds. I had to pay out more cash than what these bonds were worth. Now, if I needed more on the credit side, then that's a clue that this is a gain because it's on the debit side and losses are typically debits. Again, is reinforcing the fact that there was a loss on this disposal. So we can call this a bunch of different things. Loss on redemption of bonds, loss on paying off debt, but I like to use the term loss on redemption of bonds because redemption is just a fancy way of saying we're paying off the debt. Now, let me make sure my entry balance is here because sometimes I add 510 and 510. So when bonds are paid off early or they are redeemed, we first have to determine how much cash we're paying out by multiplying the bonds times the redemption price, sometimes called the call price, and that was the 99. Then we can determine whether or not there is a gain or loss by comparing the cash that we're going to have to pay out to the carrying value of the bonds. And because these bonds were issued at a discount, it's the difference between the par value of the bonds and the discount on bonds payable. Again, if it was a premium on bonds payable, we would be adding these two numbers together, but it's a discount, we're subtracting. So then we can proceed with our entry. We know how much cash we're paying out, we calculated that. We know that bonds payable has to come off the books, and we know the discount on bonds payable has to come off the books. The last piece that we need to record in this specific example is the loss. So this takes care of the problem. Brief exercise 14.9, where we're dealing with the redemption of bonds before the maturity date. Again, I appreciate your time and attention. I hope you have a wonderful